In today's video, I want to go through qualifying a commercial loan, and if you're trying to dive into the industry of commercial lending, this would be a wonderful video for you to watch. If you don't know who I am, my name is Zevi Shafin. I'm the owner of Loanbrook, a mortgage company in Los Angeles. We do both residential and commercial lending. And if you could do me just one little favor right before we jump into the video, just hit that like button right now so this video could get some traction and other people like yourself that are looking for this particular information can find it on YouTube and the internet, all right? With that, there's three things that I want to cover in this video with you, very specific as to the conversation that you're going to have with that person standing in front of you with a real estate agent. These things are the baseline of what makes the qualification process of a commercial loan, and it starts with number one, which is assets. Okay, there's a few things you need to know about assets, and the biggest one would be the amount of down payment that your prospect has available. And let me explain to you why. Because there's two ways to structure a commercial lending transaction. If you're going with an institutional lender, so we're just going to call it a bank, they're going to require a minimum of somewhere between, let's just say, 30% down payment on average. So if I'm having a conversation with somebody and they're like, I want to buy a warehouse for, let's just say, $3 million. So your first question is, how much of a down payment do you have saved? And if the answer is less than 30%, then going through the bank channel, the institutional channel, already you know is going to be a challenge. So we have to think outside the box and ask ourselves, are we doing this for an owner user or an investment property? And the reason I'm asking this question is because the second channel is SBA. And SBA is a guaranteed loan by the government, similar to an FHA loan on the residential side. And because you're going to go guaranteed, you can go as little as 10 to 15%. Now there are options to go up to 100%, but we're not going to get involved in that in this video. 10 to 15% down payment, and I'm just going to say here down, would allow you to go SBA versus bank financing. So as you can see, the reason my first question is, great, you found this warehouse. Now mind you, I know you're thinking, wait, you're the loan officer, you're supposed to tell me how much I'm qualified for. Yes and no, because your business runs at a certain baseline, a certain level. And if I tell you, well, let's go through all of your documents and find out that you can afford $1 million warehouse, and there's nothing in the market that is remotely close to what you're currently renting, which is something that's valued at a $3 million warehouse, simply because you need that type of space to be able to operate your facility, then it's a big waste of time for everyone. So check that box when it comes down to how much assets a borrower needs. Now there is one other thing that we're going to need to cover about assets, and just like I mentioned, two channels for you to be able to do these type of deals. Now here's the deal, all right? If it doesn't fall into the institutional bucket and it's going to be an asset-based loan, then I don't necessarily need to take it to a bank, and I don't necessarily need to take it to SBA, which is Small Business Administration. I can also go private money financing with this deal. Let's just say that, again, your prospect is trying to buy this warehouse, $3 million, and there's a lineup of buyers. No one's going to wait for you to close that deal in 60 days. If people are overbidding you, there's cash offers. So not a problem. We could actually do a hard money loan. I'm just going to go and say here private. To do a private money deal, again, tying into the assets, we need 30 to 40% down. So unless the borrower has $1 million, right? Because we're trying to buy something that's 3 million, 30% down's right around 900 plus. There's closing fees, commissions. They're not going to qualify either unless they have that amount of assets for down payment. I'm being super specific in my conversation. I'm checking the box very fast to know that these preliminary conversations are going to get me to where I need to go very quickly. Now, here's another thing that you need to know about assets. If I was going to tell you today, let me just clean this up for us. If I was going to tell you today, hey, listen, I'm going to give you personally a loan with 30% down for you to be able to buy this particular piece of real estate, whatever it may be. However, how do I know that you actually have the ability to make the monthly payment? Typically, what you're going to see from most lenders is that they wanted a security blanket of knowing that you have enough assets put away, not only to cover the down payment and the closing fees of the transaction, but they want to see something along the tunes of 10%, and we're just going to call that liquidity. So that basically means that in addition to being able to put down that 35% down payment, after it's all said and done, your business still has about 10% of liquidity. Therefore, you're not going to default on the loan because we know you have money to make the payment. Does that make sense? That all falls under the first bucket of assets. And by the way, as we go through this video, if you have any questions, just drop them in the comments below and I'll be happy to answer them for you. So that was the first pillar of us qualifying a commercial loan, is going through the asset piece. Recap, the first part was to make sure that we know we have enough money for the down payment, whether we're going institutional, 30 to 40% down, whether we're going SBA, which is 10 to 15% down, or we're trying to go hard money or private money, 30 to 40% down. And in addition to it, we want to show some liquidity, specifically 10%, and that should cover the assets bucket. Moving on to pillar number 2, which is going to be credit. Now, how does the credit conversation affect us when we're trying to put together a commercial lending deal? In a very simple format, there's always a baseline minimum for institutional lenders. So if I was gonna go to a bank trying to apply for this commercial loan that we just discussed, I would typically need a minimum credit score of about 680 for the bank or the institution to consider lending. And it would be very important to have that conversation up front, because if the person has a lot of credit derogatories, a BK, a foreclosure, anything on their credit, and the credit is, it's interesting because credit is a lot like a yo-yo, right? The more you use of it, then the more it kind of goes down, because especially over 50% leverage, you typically want to keep your expenses or your debt on your credit cards right around 50%, so it doesn't look like you're short on income or short on cash. And that's the feel that the lender gets when they run the credit and it's sub 680. Now, if this was a challenge, like I said before, where SBA wouldn't be as challenging, because we could go down to 620 to qualify on an SBA channel. But keep in mind that SBA is designed only for an owner-occupied deal. Again, comparing it to an FHA loan on the residential side. So this has to be a person who is looking not to invest in a business, but to actually take their operations out of wherever they are right now and put them into that new facility for their business. There's a couple ways to structure an SBA loan. I'm not going to necessarily get into that in this particular video, but just know that that option is available for you. And so on the credit piece, if we're seeing a lot of challenges and we're not even hitting this 620 mark, but the borrower again has that 40% down payment and a lot of liquidity, then like I mentioned before, if credit is going to be a big challenge in the transaction, then I'm going straight to private, meaning hard money. I'm letting the borrower figure out their credit, clean it up, pay their creditors, do whatever they need to do to bump that credit score back up before I go and I approach an institution or a bank, or even SBA, depending on, again, where the credit is, to be able to get that approval. There's always two options, all right? So that was the second pillar in the transaction. Recap, going to a bank, I need about a 680 minimum. Going to SBA, Small Business Administration, I need a 620 minimum. If there's just a ton of credit challenges, we go hard money, private money, structure a deal around 30-40% down. We're able to put that together, assuming that the borrower has enough assets, as we've discussed, set aside to basically make the investor feel comfortable that they are in fact able to make the payment every single month. Number 3 on our list is going to be income. Now here's the deal. It's very important to keep in mind all these milestones in your head as you're talking to the borrower, simply because you're working on commission. You really don't want to spend a bunch of your time with somebody who's completely not likely to qualify for this transaction. On the income piece, it's interesting because it really depends on what you're trying to qualify for and how the income is structured. So let's start from the top. Again, if you're heading into whether it's a bank or you're going to SBA, this business needs to have a history of 2 years. Very, very important. Somebody comes up to you and says, oh, started this business last year. Things are going great. Now I want to go buy a facility. The challenge with that is you don't have enough historical data to show whether this business has a track record of actually being successful. And so the lenders, what they like to do is always look at a 3-year history. And the way this is done, just so you know, is through something called a debt coverage ratio. It's really not that complicated. All it basically means is that your income is 25% more than the expense. And they call it 1.25% debt to coverage ratio. And I will show you how that's done in a minute. So that is the first question you want to ask. Has your business been around for more than 2 years? All right. And also, depending on what the business is, different banks have different appetites. Some banks love medical facilities. Other banks love working with people who own like mechanic shops, different things. Different lenders have different appetites. And so it's very important to know how to direct traffic. And now you might be thinking, Zevi, this stuff sounds really good. Where do I get started with it? I actually created a program last year. It's called the Part-Time Commercial Lender Academy. It's available for you via link in the description of this video. And it's actually a very easy to follow roadmap where you can go through the whole journey, plug and play with all my forms, my proprietary forms included, that you could do exactly what I do, having me on video for 40 modules explaining to you the whole process. It makes it very simple to go through the journey of a commercial loan and then obviously earn yourself a lucrative commission on the other side. So if you're interested, check out the link, Part-Time Commercial Lender available for you in the description of the video. Let's continue talking about income here for a second. Now, Since we are looking at a 3-year history, the idea is this: 1, 2, and 3. 2 out of the last 3 years, whether it's this one and this one, this one and this one, has the cash flow at 1.25%, which basically means that the income is 25% greater than the expense. Now, how would you calculate that? Well, it wouldn't be your job to do it. In the academy, I explain to you the resources that you go to, whether you're going as a BA or a bank, or even private money, that you would be able to run this individual's income to be able to figure out the correct debt to the income ratio. And the interesting part about it, there are 2 channels, so you're not surprised. This falls into 2 categories. There is the business category, and then there is the personal category. All right? And so basically on the business end, typically the income could be even a 1-to-1 ratio. But on the personal, it does need to be 1.25, which basically means that if my business, in terms of income and expense, cash flows to the point where my business can break even with making the payment, that would be considered a 1-to-1 ratio. I can sustain the expense. However, on my personal side, meaning once you pull in my personal liabilities, then you do have to show that you have other sources that can cash flow 25% more. This way, in a very simple explanation, if you gave me a loan today for $1,000 every single month, where I actually had to pay you back $1,000 every month, you would at least want to know that I make $1,250, that not only can I pay you the debt, but I do make more money, that there's not going to be a position of default. And that's basically the whole idea. So that's a good benchmark for the income. You don't have to cash flow it. Whomever it is you're working with on the transaction typically can do that piece for you. I discuss all of it in the academy. All right. And so those are the biggest things that you need to know. I do want to throw one other things into the income piece that can kind of connect the dots for you. Now, typically speaking, when somebody's going to want to buy a facility, when you're talking about income, the first thing you condition for is you want to see the last 3 years of their income and expenses. And most businesses are going to run either in 1120, which is a C corporation. Again, we don't want to get too technical. Or they're going to run most common 1120S, which is an S corp. Now, without getting very technical, the first page on both of these is typically the page where you see the income and the expenses. We're going to call it a P&L, which is a profit and loss. In that profit and loss, there's going to be a line item that's going to identify how much rent the current business is paying. And that's because if they're buying a facility right now, there's a good chance that they're renting. Maybe they're not. Maybe they're paying a mortgage, and that would be in there as well. You can compare that to the proposed payment of whatever it is they're trying to buy now. And how would you actually do that? So, again, in the academy, I give you the resource for a mortgage calculator, or you could just pull that up for yourself. And I would imagine that whatever rate environment you're in when you're watching this video, and I will give you this example. So if I'm in a rate environment today of 6.5% to 7%, and I know that commercial loans are amortized over 25 years, then basically if this individual was going to buy a place for $3 million, like we've discussed, and I know that they're going to need 30 to 40% down So I'm just going to say $1 million is the down payment. And I'm looking at a $2 million loan. Okay? If I take this loan at a 7% rate and I amortize it over 25 years, then I can figure out what the payment is. And also, depending on where you are in your county, there's property taxes and insurance. You can baseline those. Once you know the principal and interest payment, the tax, property tax and the insurance, you can compare it to whatever it is that they're paying right now in the rent. And we're going to take it one step further. If right now their business is generating $3 million a year and they have $2 million in expenses, and we're just going to say this is going to be income, this is going to be expense. So their bottom line, they're making $1 million. Now clearly this is a very healthy business for somebody to be netting $1 million. And you're asking yourself, okay, they're netting $1 million. How would I know if they actually qualify? Because in that $2 million, remember, of the expenses, there was a line item. And in that line item was rent or mortgage. And you can compare it to what the proposed new mortgage would be. And if it's already included here and they're making $1 million net, then they would qualify with flying colors. All right? Even if this wasn't $1 million, even if their expenses here were $2,900,000 and they were netting $100,000, if they were netting $100,000 every single year, and a part of the expenses here was the rent and the mortgage, and you compare it to the new rent and the mortgage based on this new loan amount, all right, and it works, then again, you're not making a credit decision, an underwriting decision. That's not your job, but it gives you an idea of what that would look like, all right? And if their income 2 years ago was $2 million and today it's $100,000, then the income, you use declining income. It's gonna always be the lower, all right? So hopefully that helps you guys out. Like I mentioned, if you wanna learn more about this, please check out the Part-Time Commercial Lender Academy in the description of this video. If you have any questions, please drop them in the comments. I would love to read them. I would love to answer them for you. If you've enjoyed the video, please give it a thumbs up so other people like yourself can find it on both YouTube and on the internet. Otherwise, thank you guys for being here. Thank you for watching this, and I'll catch you again on my next video. Take care.